Hi, welcome to Control and Compound with Darren Mitchell. I'm your host, Darren Mitchell, and with me today is Christina Wyatt, wealth coach at Control and Compound Financial. How you doing, Christina?
Hey, Darren, I am doing awesome. How are you doing today?
I'm doing fantastic. So, really excited about this podcast. We get a lot of questions. Just what is infinite banking? Does it work for Canadians? So, we're going to spend this podcast breaking down in detail what infinite banking is. Christina, you excited for this?
Yeah, this one I'm super excited for. I really think I wanted to do this podcast because we talk about infinite banking all of the time. Obviously, this is what we specialize in, and we chat about it in our podcast. But there's got to be people out there saying, what are they talking about? What is this infinite banking? So super excited to be able to break this down today. Went digging through the archives though, found this clip that you made, Darren, and I really want to start here. You did infinite banking in less than 2 minutes. It's going to be rapid fire, but I totally think that we should start with this and then go back and break it down. Do you think you'd be all right if we pulled that clip up and let everybody listen?
Sure. Let's roll the clip and then we'll break it down in more detail after. So here in less than 2 minutes is what infinite banking is for Canadians. Hi, I'm Darren Mitchell from Control and Compound Financial, and I'm going to try to describe to Canadians infinite banking in 2 minutes. First of all, it's a specially designed cash value life insurance policy. We're going to have maximum fund, a participating whole life. It's got to be participating whole life. It's going to come with two parts, death benefit, people get the death benefit, but it's also going to come with the cash value. And our goal is to jam as much cash in there to grow the cash value as fast as possible. It's also going to pay a dividend each year, or has for the last 100 plus years. That dividend's not going to be a physical check. It's going to grow your cash value and grow your death benefit. But what it's going to happen is going to put you in a position of control. Let's say year 2, 3, or 4, amazing opportunity comes along, real estate opportunity, business opportunity, whatever the opportunity is, you can borrow 90% of the cash value to go take advantage of that opportunity. So your money's over there taking advantage of it. But you've created an and asset because your money's still inside the policy, unaffected by the loan, and it's taking advantage of the opportunity, and it's providing a death benefit for your family. And then we've achieved what the wealthy want, uninterrupted compounding, literally for the rest of your life till the day you die, unaffected by taxes, fees, volatility, and spending. We get to retirement, you go, listen, Darren, this was great. I'm way wealthier than I would have been otherwise because I took advantage of all these opportunities because I had access and control. What do I do with this now? Well, now there's all kinds of different ways we can spend it in retirement. Simple one is, why don't we borrow against the cash value, use these tax-free loans, top up our retirement income, never pay these back until death. Then at death, we've had this massive death benefit in cash value because we've had uninterrupted growth for 30, 40, 50 years. Death benefit pays off the loan. The difference, the amount of over and above the loan, that goes to your family completely tax-free. That's infinite banking in Canada. Okay, Christina. Well, I guess that's it for the podcast today. We got everything covered.
I don't know about that, Darren. That was quite rapid fire. You got a lot of information in there, great information, but I really think that we should take the time and, go through each of these things and kind of break them down a little bit more.
Okay, so let's start from the beginning. What is infinite banking, Christina?
So, infinite banking is a strategy, or they call it a concept, a strategy to grow your wealth. So, it's not a product, it is a strategy that individuals, business owners, real estate investors, people can use to grow their wealth for the short and long term. Now, I think the next step that we should talk about, though, is we do need a product in order to implement this strategy. So, Darren, why don't you talk a bit about the product that we have to use to implement and use the strategy?
Yeah, and I mean, you could use any product for infinite banking. Just if you want to use what we found is by far the best product, it's participating whole life. And participating whole life, there's very few companies that offer it in Canada, but it's what's called participating because the fund itself is actually owned by the policyholders. So when you look at, the 12 or 20 billion or whatever's in the particular company's participating whole life, all the profit from that and all the benefits of that go back to the policyholders because they actually own the fund. The insurance company just manages it. The policyholders own the fund. So that's why we call it participating. And that's a key factor that you have to have a participating whole life. Now, Christina, this participating whole life, is it the latest, greatest, let's get rich quick scheme? Like, how long's this thing been around?
So the whole life product and really the strategy, because we could have been using it all the way back since then, has been around since 1846. So it's definitely not the latest greatest get rich type thing. It is a very old product. People have been using it for generations. Wealthy people have been using this for generations. Like if we look back in time, some of the wealthiest people that you've heard of have used whole life to create their, to create their wealth, and then also to create generational wealth. So this is a very long, it's been around for a very long time. Now, why haven't we heard about it? A lot of people ask us, why are we just hearing infinite banking for the first time now? Why is that?
Yeah, and great point, Christine. It has been around forever. I mean, there's all kinds of cool stories about how, Ted Rogers used it to build Rogers, and Walt Disney started Walt Disney with a policy loan, and the Rockefellers continue to be wealthy because they continue to use this whole life product. But really, in the 1990s, Nelson Nash, who's an incredible man, passed away a few years ago. He wrote a book called Becoming Your Own Banker, and that was really Nelson in the 90s was really started designing these policies. They always had cash value and death benefit, but started focusing on growing that cash value as early and as fast as possible. So Nelson's book was really kind of the start of what we called infinite banking, but the product and the concept's been around forever. It just Nelson showed us how to do it better and how to have that cash earlier, have access to cash earlier and grow that cash faster and earlier. So really since the 1990s, the term infinite banking's been around.
Yeah, so it's been around for quite some time. We talked about the product. So we purchased this product just like you would if you were doing a planning and you purchased an RSP, right? But you purchased this product, this specific product, to be able to implement the strategy. Now you've got your cash value growing like we want it to grow, and we start using this. There's benefits to using this outside of other strategies you might heard of. So I want to break down the benefits that come with using the infinite banking and storing your money in one of these products versus somewhere else to be able to get the strategy rolling. So why don't we go through a few of those, Darren? Where do we want to start?
Sure. Well, yeah. For me, control is the most important thing, right? And that's why wealthy people have been using this for years. I want to be in control of my money because I promise you a couple things will happen to you financially. There's going to be opportunities come your way, and there's going to be financial emergencies, and how you deal with those literally can change your financial future. So for me, I want to be in control. And then we also have this really cool thing, an and asset. Christina, why don't you explain what an and asset is versus an or asset?
Okay, well, start with the OR asset. So an OR asset is, almost every asset you have right now is an OR asset. Do I invest in my tax-free savings account, or do I invest in real estate? Do I invest in crypto, or do I invest in my business, right? You're deciding which one you want to invest in. When you put your money into the participating whole life, when you start this strategy, you don't have to pick one or the other. That's the beauty of it. You can actually do both because your money's going to be inside of this policy, compounding, which we're going to talk about in just a second, uninterrupted compounding. And at the same time, you're able to take that money and you're able to invest in those other opportunities, like you just talked about, having control to be able to invest in those opportunities. So your money's going to be inside the policy, compounding uninterrupted. And you're going to be able to take your money and you're going to be able to put it into your business, put it into real estate, put it into all of those other great opportunities that, a wealthy individual sees come by, quite often, that you're going to want to take advantage of.
Yeah, I love that. So your money's in the policy, growing tax free for the rest of your life, and it's taking advantage of an opportunity dealing with an expense or an emergency, and it's providing a death benefit. So we're kind of multiplying money, and that's why it's
Oh,
an
I forgot the
and.
death benefit there. You're right, Darren. And we have the
Yeah.
death benefit on top of it. I get so excited about the opportunities and, being able to go out and invest. I forget about that death benefit, but it's very important too. You're absolutely right.
Yeah, it's funny. People come in and then they're like 20s, 30s. I don't care about the death benefit. I don't care about the death benefit. Fast forward 10, 15 years, all of a sudden they're like, Well, that death benefit's kind of cool. There's all kinds of cool things you can do with that death benefit, and we'll talk about that. And then, so we got control, we get the and then for me, the other big one is compounding, right? We want uninterrupted compounding. Now, we throw that term out, and for those, just learning about the concept, let's dig into the difference between uninterrupted compounding. That's what the wealthy want, and that's what the wealthy usually achieve. And interrupted compounding. And interrupted compounding, you think you're a compound interest curve, well, it gets interrupted. And what's the biggest thing that interrupts the compound curve for most people?
Taxes. So when we're looking at people's the growth when they're investing, they're consistently being interrupted by taxes that have to be paid throughout that growth curve. That's one of the things about the strategy why we use it. It's because it's going to eliminate these things that interrupt that compounding. One of them being taxes. With this policy, when you put your money in here, it's going to grow tax free. You're going to be able to access it tax-free through policy loans. We're going to talk about those again in just a second. So policy loans, and then when you die, it's going to be tax-free as well. So we can eliminate that interruption that's going to hit from those taxes when we put our money inside of one of these products and use the strategy. That's just one of the interruptions though, Darren. What's another interruption?
Well, the other big one is fees, right? So, and this goes back to why we want this participating whole life. The average mutual fund in Canada is still 2% plus in investment management fee. Well, these participating whole life funds we use, they're actually federally regulated with respect to fees. So if you think of all the insurance products out there, mutual fund companies, bank products, you add them all together. Well, it's really just the participating whole life that are federally regulated, and they say, okay, here's how much you can charge in fees based upon the size of your fund. And put it in perspective, mutual fund 2.2%. These tend to be 12 to 10 to 20 basis points. So like 15 basis points would be 0.15% investment expenses versus 2%. So incredibly low fee. And really, the next one is volatility, Christina. And you explain volatility, how that is getting you off that compound interest curve.
So volatility is going to impact your uninterrupted compounding. It's going to interrupt it because the volatility in the markets, the stock market, the real estate market, well, the volatility in itself going up and down throughout your earnings are going to impact it for sure. Now, people will say historically the stock market's always gone up, historically real estate's gone up. The issue is though that if you need to take out when one of these markets are down, you're going to lose. And that is going to completely take you out of that compound growth curve and take you off the curve. You're going to lose those returns that you've gained, which is not what we want. What we want at the end of the day is that uninterrupted compounding, and that volatility is going to throw a wrench in it.
Yeah, it's like volatility. It's really impactful at all stages of your life, right? People typically go, well, if I'm in my 30s and the markets go down, no big deal. But when the best opportunities usually come along is when the markets are down, or when the real estate market is down, or when crypto is down, or whatever you want to invest in or buy a business. Really, when you need the money the most, if you're in a volatile investment, that's when you have the least access to it, and you probably wouldn't access it. And then you get all the way to retirement, and volatility in retirement is just a crusher. And we've got separate videos on that we can share another day. But if you start taking money out, you retired in 2007 with $1 million, and 2008 and 9 hits, and you start taking money out in that low market, well, you just don't recover. So volatility, people don't think of it as really just a devastating impact on your finances, but that's what it is. Just one more point on volatility before we jump to the next one. So with the participating whole life, the volatility in that product, for those of you who know what a standard deviation is, standard deviation's fancy term for saying how much does it bounce up and down, right? How much each year does it go up and down? Well, it's got a standard deviation of around 1% and change, most of the companies we use. And the stock market has a volatility of 16% standard deviation. So really what that means is stock market's going to be bouncing up and down, and this is just going to be so just boring but effective. Just goes up every year. Down years it goes up years it goes up. 2008 it went up. Every year it just plugs along, goes up. And that's really important when you want to take advantage of those opportunities. And this product eliminates that volatility. And then the last one is spending. For me, spending, like we talk about taxes because people, great, grows tax free, access to tax free, die tax free is great. Well, the reality is spending in a lot of cases is a bigger impact than tax, because people save money, they start compounding, they start going on that compound interest curve, and then they cash out their investment, they cash out their savings, they to buy a property, buy a car, pay an expense, take advantage of a opportunity when the prices are down. Well, what you're doing is you're going right back to zero on the compound interest curve. You're literally restarting the compounding. So you compound for a few years, go back to zero. Compound for a few years, go back to zero. So with this cash value life insurance policy, participating whole life, you're able to stay on that compound interest curve, because when you need to go access money, you can leave your money in the policy and allow it to continue to compound, and you can borrow 90% of that cash value and go take advantage of that opportunity or pay that expense. And that loan does not affect your growth of the policy. So even though you have a loan outstanding against the policy, that policy continues, the cash value continues to grow uninterrupted. So it grows the same if you have a loan or don't have a loan. A lot of people, that's a tough one to get at the beginning.
Yeah, it's a trickier one to grab. The taxes make sense. Everybody, oh, no taxes. That's like, we need that, obviously. This one's a little bit different because, it's been ingrained in our minds that you want to pay debt, debt's bad, and all of those things. But spending can be just as bad, which is what we're talking about here. Because you want to be able to keep that uninterrupted growth. And I know when I try to explain to people, sometimes I'll use the example of if you had money in if you had money in a tax-free savings account, that's great. That's tax-free. That's fine. And then you had money in this, in the whole life policy and the strategy. And let's say you had, 20,000 in each of them, and you took 20,000 out of the tax-free savings account to go do your opportunity. Well, how much are you earning in that now? Zero. You've got $0. If I take 20,000 from my whole life policy to go use it for that opportunity, I'm still earning on the 20,000 inside the policy, right? It's still earning. And that's the big difference, right? That's that and asset that I talked about a little bit earlier. It explains it quite well, because I'm going to have my money inside the policy compounding uninterrupted, and I'm going to have it out doing that real estate deal or crypto, whatever we're working on at that point in time, right? So that's how it ties in. The and asset, the spending ties in quite well, kind of explains that.
Great explanation. Thanks, Christina. And then we get into retirement. So what happens with this in retirement? Is this only good while I'm working, or is there benefits for retirement as well?
Lots of benefits for retirement as well. So a lot. So if we start with, that uninterrupted compounding, it's been compounding for quite some time now, right? So we've had this policy for a while. We've got a lot of cash values built up in there. We've done all the things that we wanted to do. We've significantly grown our wealth more than we thought we could. Got that cash sitting there. What do we do with that cash now? Now we start taking these fun loans, these loans that are going to, top up our retirement lifestyle, going to put us on a beach somewhere. And we can use those each and every year. And Darren, when do we pay those loans back?
Never.
Exactly. And not necessarily never, it's on death, right? So these loans are going to get paid back on death, which means your money, even though you're using it, is still compounding inside of that policy, right? So it's compounding. It's never getting taken out. So the typical 65-year-old goes to retire, they start spending down their assets, which means they're going to earn less returns on those assets because there's less assets available to earn returns on. Whereas when we're using the strategy, we're not touching our money. Remember, we're going and we're using the insurance company's money with those policy loans. So our money's still growing in there, all of it. All of it's still growing in there. So these loans that we can take out in retirement are significantly higher than what a traditional investment could take out because we're still earning that growth.
Yeah, and I mean, you can do policy loans and you can also do bank loans that usually has lower interest rate, and we'll talk about that in another podcast. But yeah, I love your point of you don't stop the compounding even when you retire. So, you could retire with $1 million of cash value and start borrowing against that value and using that money just to top up your lifestyle, an extra 100 grand a year or whatever your number is, and say, great, I'm just going to spend that 100 grand a year. I'm not going to get a tax slip on it. It's going to just be extra money that me and my family can spend. But that $1 million of cash value, maybe by the time I die, could be worth 2 million, 3 million, or more because it's continually compounding. And if you think of compound interest curve, those years 30 through 40 or 40 through 50 or 50 through 60, you're getting those massive upticks in the compound interest curve. So your cash value is growing and your death benefit is growing. And I mentioned death benefit because it is relevant, right? People are focused on the cash value, but trust me, when you're in your 70s and 80s, that death benefit, you're going to say, well, that's pretty important and pretty cool that, great, all this tax I'm going to owe at death, there's going to be a death benefit. And there's always going to be a death benefit. So, if you end up being successful and wealthy and you don't need to access this in retirement, you're going to leave a massive tax-free death benefit. If you decide that you want to spend most of your own death benefit, which is kind of cool, you're effectively spending your own death benefit, great. There's still going to be death benefit because we've got the death benefit up here. It's always going to be the highest. Then we've got the cash value down here. And then we've got maximum 90% loan. So the difference between that loan and the death benefit, there's always going to be extra tax-free money for your family. And you decide how much of your own death benefit you spend, a little, a lot, or none. But in all three of those scenarios, who's the only loser in those scenarios, Christina?
CRA. CRA
Oh,
is the
God.
loser.
Are you
Love
okay
it.
with that?
I love that part. It's one of my favorite parts of the strategy. Loser
All right.
CRA.
So we've got a participating whole life. We've got to save money somewhere. We really haven't found a better place to save. And it has all these huge benefits, allows us to multiply our money and take advantage of opportunities, deal with emergencies, stay on the compound interest curve. Let's dig into some of these questions, Christina. Can anybody use infinite banking, or is it only certain people that qualify? Who can use it?
So anybody can use infinite banking. Now you do have to qualify because it is a life insurance policy, but it's the insured that has to qualify. So we can go down that road and talking about it, but at the end of the day, almost anybody can use infinite banking if they take the time to learn about it. So it is something that you have to, you got to invest some time into learning about, gaining more knowledge on, so that you can actually utilize the strategy. Because if we don't, if you don't know about it, you can't use it properly. And that's one thing that we really encourage, is that if you want to start using it, the first thing you got to do is you got to learn about it, and start doing your research, and then you can go ahead and implement it.
Love it. And then the other thing I really love about it is we get the question, is this for my short-term money or my long-term money? Because that's kind of how we're programmed to think, right? Most people go, okay, my short-term money, I'm going to put it in my bank account and just earn 0% interest and minus the fees probably. And I'm just going to leave it there because, I want to have access to this money and I can't put that in a volatile situation like the stock market. I want to have access to it. Now you give up, basically any real growth potential, but you do have control and access to it. Or people go, well, this money I'm going to save long term. I'm going to put it in traditionally an RSP, and I'm going to let it sit there in RSP jail for the next 20, 30, 40 years, and then I'm going to take a little piece out. So that's short term money and long term money. The advantage of the long term money with the RSP, great. You have this long term compounding, hopefully, that if your returns do okay, but you don't really have access and control of that money. So this strategy is sort of the best of both worlds. I love it that I can use it in the short term. I've got money in my cash value growing, and great. I see an opportunity come along. I see the stock market crash. I see a chance to buy Bitcoin. I see a chance to buy a business or buy a piece of real estate. I can take advantage of that opportunity in the short term. But because we have that and asset you talked about, Christina, it doesn't affect my long-term wealth. When I do hit retirement, I'm still going to have that cash value because that grew completely uninterrupted by the fact that I borrowed and paid back these loans 10, 20, 30 times. So it's great for short-term money as well as long-term money. It's really the best of both worlds. Now, we talk a lot about business owners and real estate investors. Yes, it's wonderful for them. It can be for anyone. You don't have to be a business owner or a real estate investor. But why does this resonate so well with business owners and real estate investors?
I think that for business owners, real estate investors, they follow the philosophies that go with this strategy, right? They always want to be in control of their money because they want to get that next real estate deal. They want to be able to put money back into their business because they know that's where they earn their biggest returns, right? They know that putting $10,000 into the stock market and looking for a 2 or a 4 to 6% return is not where they're going to see their biggest returns. They know that. We don't have to explain that to them, right? So they get it. They get that they have to be in control of their money. They already know how the banks make their money because they work with them regularly and getting their loans for their, their real estate, their mortgages, their business. They know exactly how it works. They know that the bank's out there multiplying their dollars and having it working in more than one place. And they want to do that too, right? They get that. So they want the compounding they want that uninterrupted compounding, but they want control. They want the best of both worlds. I think a lot of business owners want the best of both worlds, and they realize that when they use this strategy, they can have that, right? They can use the strategy and they can have their business, they can have their real estate, they can have their cake and eat it too, right? They get both sides.
Yeah, I love it. I mean, if you look at business owners and real estate investors, they tend to be the wealthiest people tend to be real estate investors or business owners. And we go back in we're believers, and if you want to be rich, do what the rich people do. Rich people invest in themselves, they invest in businesses, and they invest in real estate. And if you think of every rich person, I'm pretty sure they would have done one of those things, right? Invest in you take a course, you listen to this webinar or watch it, you read my book, all these different things. You invest in business and real estate. Well, the business owners and real estate investors get that. They're like, all right, if I'm going to have the greatest rate of return, those are the three areas I should be investing in. And in order to do that, I need to be in control of my money. So I think that's why it resonates so well with business owners. And real estate investors, they see the importance of having access to money and being in control of money, because with that access and control, you can take advantage of opportunities, and those opportunities are what's going to make you way more money than a traditional RSP or whatever. But then you still have that short term and long term. Use it in the short term, still benefit for you from the long term. What else, Christina, before we wrap up, should we look at today?
I think, if we did this, it wasn't as quickly as Darren's 2 minutes, right? But we broke this down in different categories, kind of talked about it. But if you're intrigued to learn more, like I had said, the first thing that you want to do is you want to continue this research. You want to learn more. So what's the best way to do that, Darren?
Well, this might be slightly biased, but I think Be the Bank. It was a good-looking bald guy. Darren Mitchell wrote it. It's on Amazon bestseller. But Nelson's book, Becoming Your Own Banker, is fantastic. Be the Bank. Nelson was an inspiration for me, and I was trying to show how the infinite banking works for Canadians. Slightly different. And I think the key is, if you want to learn more, you've got the people that use this strategy and do it well. They've put in some time to educate themselves, okay? And that's why wealthy business people and real estate investors, they're used to that, right? You don't get wealthy just by, dumb luck. You get wealthy by investing time and energy into learning something, right? So you need to learn it. So my book's a great one. Nelson's book's a great one. There's all kinds of podcasts and webinars you can listen to. And then, if you want that education session, one-on-one learning, reach out to us, go to controlandcompound.com. We've got to contact us. And we offer a no money down, no commitment, free education session, one-on-one with the wealth coach, and say, okay, explain how this works and show me how it would actually work for me. And these are my circumstances. Can it work here? Like, what if I'm this old? What if I'm in this situation? What if I'm saving this much amount of money? And we really kind of just try to try to get the numbers real for you, because we didn't show any examples today, because the examples might apply to a couple people, but they're not going to apply to everyone, because everyone ends up having a different thing. So work with a firm that specializes in this, instead of someone that just also does this on the side every now and again. Put the time in educating it, and if you're ready for that next step and you want to have a one-on-one meeting, no obligation, reach out to us on controlandcompound.com. Christina, thanks for pushing me to get this podcast done. I think it is a great topic. What is infinite banking for Canadians? So thanks for watching. Thanks for listening. Look forward to chatting. Take care. Thanks for tuning into this episode. Don't forget to like, subscribe, and hit that bell button so you always know when new content is coming out. For more helpful tips and tricks, visit our Instagram, Facebook, or TikTok pages at Control and Compound. If you want to reach out to us directly or work with us, visit our website at controlandcompound.com. The links are in the show notes below. See you next episode.